Okay, we start the efficient market hypothesis. It is not a new topic, but it is a quite challenging topic if you don't understand it well, because in the exam, I found this topic is quite the students are not familiar with this topic. Maybe it is quite they don't find the linkage of this topic to other financial management areas. So maybe I'm here to explain some about the background of this efficient market hypothesis first. So the background is we are the shareholders. We have the financial management objective is to maximize the return of the shareholding. So the financial management objective, one of the objectives is to maximize shareholder wealth, right? Is one of the financial management objective of a company. You have to maximize the shareholder wealth. So the shareholders, okay, honestly, the investment in shares, they demand the maximum return is just a rational man to do it. So for them to invest in the company shares, the company must offer return at least as good as available elsewhere for the risk they are taking, and also at least as good as spending the money now. So for a single period model, the return is the dividend yield plus any capital gain in percentage term. So it's the basic model to analyze the investor return. So simple, we have the dividend per share, 10 penny, and the value is 100 penny at the start of the period, and by the end of the period, we are 150. So what's the return? So here maybe you get 10% plus 50%, right? So 60%. So here is the very basic calculation of the investor return. Just remind you the concept. So here we understand the share price, 150, and also 100. Okay, this is the share price. We can find the share price in the market movement. The share price is just like how to say that, it's just moving every day. But for the dividend, okay, it is quite stable. When we announce a dividend, then you or dividends, say for example 10p per share this year, maybe next year is also 10p, maybe a bit higher or lower. If the business is performing well, maybe a bit higher, but it is a bit stable and quite usual to it is quite easy instead of the share price. And also you can find that only 10% from the dividend yield, but can be 50% in the share price movement or in the capital gains. So for the share price movement, we are looking at this topic here now. So investor return asset, share price movement is one of the topics which is uncertain, and for future dividends payment, which depends on company performance on selected projects, so it is a bit more certain. Okay, you can a bit more certain about the future dividend payment, but share price movement, it depends a lot, and you cannot estimate it well, especially we have the market sentiment. And we have different risk factors. It can be systematic risk, it can be unsystematic risk. Okay.